Okay, good morning, everyone. Sorry for the 1 minute delay. Had to get this all set up. The microphone didn't want to work. But today we are up already 0.85% after a bad but good jobs report. The first jobs report that came in higher than expected since November of 2022. So if we go over to my Twitter page, talked about this morning. Initial jobless claims came in worse than expected for the first time since November 2022. 196,000 initial jobless claims versus 190,000 expected, and this is up from the week prior, 183,000. So there are about 7% more unemployment claims filed this week than the week previously. So we could see either volatility in the labor market, or we might see it starting to cool off, especially after what we saw in January for the non-farm payrolls. So that's the jobs report. Came in higher than expected for the first time since November. And if we go over to the economic calendar, I also want to look at the total jobless claims. Let's see. Economic calendar. All right, for some reason this doesn't want to work for me, but continuing jobless claims. This is the total number of people that are on unemployment. Came in at 1.688 or 1.6 million people versus previously 1.65 million. So about 30,000 more people, 38,000 more people that don't have a job this week than the week prior. And this has been slowly kind of trickling up. But let's see. I think this is the first decent uptick. That's what it looks like. 166, 165, 165, 167, 163, 164 and a half. So we haven't really seen this big of an uptick in unemployment in a while, last few weeks at least. So for some reason, January just seemed like a really good month for the labor market, and now we could potentially see that cooling off, or it just might be volatility since this is reported on a weekly basis. It's so frequent that you're going to see, a tick up, tick down the next week, and just kind of fluctuates a lot. But SPY is reacting positively to this so far. Let's see. This came out at 8:30 in the morning. We did rally before the report came out. Sorry, I can't really see too well. But at 8:30, we started at 413.85. I think that we're going to stay above $413 or $412 right now. We're close to the $413.95 support level. That's where I would want to pick up a trade if I am going to trade bullish today. So I'm thinking we're going to be bullish or neutral, and the reason why I would be neutral instead of just full tilt bullish was because of the Fed comments that came out yesterday. Again, posted this one on my Twitter page too. Basically the highlights of each Fed member's speech. Kashkari said, most of my colleagues expect rates to go above 5%, could certainly be higher. Wage growth is too high to support 2% inflation. Fed Williams said we will need to stay more restrictive for years to come. If financial conditions loosen, we will have to go higher with the rates. Fed policy is barely restrictive right now, and if services inflation persists, we will need to raise rates higher than previously projected. So basically, three of the Fed members, Williams, Kashkari, and Fed Chair Powell, in his interview the other day, have said that rates could go higher than previously projected at 5.0 to 5.25%. And this was almost immediately felt in the FOMC countdown tool, where the rates The odds of going to 5.25 to 5.5% jumped pretty significantly from the week before. They're not expecting this to happen until, I think, June. And there's about a 28.5% chance of going that high. Whereas previously, there was only a 1.9% chance a week ago. But yesterday, it was a 34.9% chance. So this new jobs data, this new unemployment data, cooled off the bond rates because this is showing the start, possibly the start to a softening labor market, but not seeing confirmation until we have probably a few more weeks of data, I would assume. But we're coming below 413.95 right now. The RSI is below 45, so in terms of technicals, we are bearish right now. I'm still bullish though, and I think that it's pretty safe to say that we'll stay above 412. So I'm going to try to open a put credit spread. Currently we're up by 0.75%. And if we go back to 412, we would only be up around 0.5%. So that's not much of a drop, but I'm sure the credit for these are pretty handsome, I would imagine. Let's see, the 412 put credit spread is currently paying $26 in credit, $27 in credit. And we are blowing past that 413.95 level. Hard to say with the volume just because this is the first 5 minutes. Can't really rely on rising or falling volume in the first 10 to 15 minutes. Makes it harder to make a decision, which is why I prefer to wait, a good 10 to 15 minutes. But this seems like too good of an opportunity to pass up, in my opinion. I'm not going to put a lot of money down on it just because, the uncertainty of opening in the first 10 minutes. So I'm only going to put down maybe a couple $100 right now. And they're going for 25 each, so I can open roughly 3 of them. They just went to 26 piece. SPY is at 413.60. So I can get 26 for 3, $78 in credit, and score. We got filled. All right, so let me post that over in the Premium Discord Trade Alerts tab. That is the first trade for today. Not risking a lot, just because, again, we're not too far off of that strike price. But seems like a pretty good trade to open based on the fundamentals. New options alert. Premium 101. All right, just opened a new 412 SPY put credit spread that expires today, 2/9. So this is a day trade at 26 each. Day trade. Sweet. Fundamentals and econ data positive today with unemployment coming in higher than expected, showing possibility of cooling labor market, and 10-year treasury yield gapped down overnight with the dollar. So if we look at 10-year treasury yield and the dollar, the 10-year treasury yield went from, let's see, a close at 3.653 to currently 3.59, and it went all the way as low as 3.575. So whenever the treasury yields pull back, you'll usually see a knee-jerk reaction of tech and growth going up, which is exactly what we were seeing for Q, currently up 1.1%. And the dollar, on the other hand, is still kind of headed down. Definitely headed down from a close of 103.41 for the DIX index to currently 102.70. So both of these are fundamental shifts from the day before, where rates and the dollar were going up, which means that tech and growth got a hit. Whereas now we're seeing the reverse, so Qs should end up doing a little bit better today. We could have even opened a QQQ trade instead of a SPY put credit spread, but then we would have to do the technical analysis and everything for the Qs. I think I have some technical analysis for it. Yeah, 304.43 support right now. I would say there's a good chance that we stay above that too. We could even open that, but then I feel like we would be over leveraged to the upside. I don't know. If it's paying a good credit, then might be worth it. Assuming that QQQ will be above 304 today, we will get paid $16 in credit. That's a decent price, but I would prefer to get like 18 to 20 personally. The Dow is doing pretty well today, up 0.7%. So that is fueling some gains for my Dow Jones trade that I took on, I think, at around 3 o'clock yesterday. So if y'all want to see the trades that I make outside of this live session during the first couple hours of trading, check out the premium Discord. It's linked in the pinned comment for the live chat. Usually I'll make like 1 or 2 other trades outside of the live session. So if y'all don't want to miss that, make sure to sign up. There is a free trial for it. But I actually ended up opening a McDonald's put credit spread. And my assumption is that McDonald's will stay above $260 with my expiration date set to next week, February 17th. Hi, Eric. Welcome to the chat. Yeah, now Q's is getting a little bit of a bounce at the moment. We were down to 307, currently 307.25. So no supports here, so I don't find that too convincing unless I'm just missing out on some supports since I haven't done a detailed technical analysis. Let's see, we can look at the hourly chart. There's some closing prices around 306 that we're coming close to. There's a closing price at 311.76, which we're definitely below. Closing price here was 305.94. So that might be where we end up taking the bounce. Actually, closing price of 306.18. So that's, let's see, 306.18. Make this blue so we can indicate that it's on the hourly chart. And then some price levels to look out above. I would take the average of this candle of significance, but it's pretty close to this 306.18 level already, so not really necessary. And then further upside, we could see this close right here, which is pretty close to these candles of significance too. Roughly 309.85. So that's definitely going to be an important mark to watch for the Qs today. Hi, Guile. All right, what else we got going on? Uber is holding, currently at 37, still above the risk range for this week. I wonder if we're going to stay above 37.50. It really depends on, I feel like, the treasury yields and the dollar. If those start to creep back up, then Uber might end up coming back down to inside of the risk range. I ended up closing out of the put credit spread that I had for Uber. I opened after their earnings. So if we head to my spreadsheet for the February log, I ended up making, I think, like $50 or so on this trade. Uber put credit spread, this trade right here, ended up making $45. I opened them at 20 cents credit each. I ended up closing them at 5 cents credit. Probably could have held them to today and got out at an even lower price and made more profit, but if it's trading at 5 cents, then it's not really worth holding, considering that it has another week until expiration. I would rather just get rid of it. Actually, no, it had 1 day till expiration. So that's why I was kind of worried about it. And just in case, we swung down this morning. But other than that, yesterday I ended up reaching my goal of $100, $109 that I made yesterday. So the average profit and loss for the start to this month, the last 1, 2, 3, 4, 5, 6 days of trading. Not a lot of data to go by, but last 6 days of trading, I've been making $100 a day. That's been my goal, so hopefully we can sustain it. And if we look at the January calendar, this is the 2 days here, and 3, 4, 5, 6, 7, 8 green days in a row. Hopefully we can keep this rally going. Hopefully we can get to 10. That would be ideal. 10 or more is what I'm hoping for. Wells Fargo ended up adjusting price target for Uber to 53 from 46. Maintains an overweight rating. That's not a bad investment. I talked about it the other day and why I think Uber is actually a decent investment, because they are free cash flow positive, whereas I thought that they would be hemorrhaging cash like crazy, just because, this is a growth-focused company, and usually growth-focused companies spend money like drunk sailors. But Uber is actually managing their cash flows pretty well. So that's something that you really want to see, especially right now whenever the Fed is tightening interest rates. You want a company that's saving up cash. If the company isn't saving up cash and paying off their debts, that's probably not a company that you want to be in, because interest rates are going up. So that means that they're going to be paying more on their debt. So if they're heavily leveraged in debt, it's not a good sign for a company right now. So you want to avoid companies that have a lot of debt, and you want to find companies that have positive free cash flow, which is cash flow from operating, from the operating, forget the name of it right now, basically operating income. So you want the business itself to be making money and not be reliant on financing and investment activities. Yeah, yesterday was pretty crazy for a lot of the market, thanks to the Fed coming out and basically walking back what Fed Chair Powell said Wednesday and Tuesday. That's why you saw such a significant pullback. Basically, all the Fed members were saying, yeah, we're going to raise rates higher if we see inflation continue to persist when it comes to services inflation. So as long as that ends up staying as high as it is, then no bueno for stocks. Good morning. All right. Let's head on over to the Robinhood. I think that I will be up on the put credit spread that I opened first thing this morning. Yep, up by $15 at the moment. I am losing some money for the QQQ put debit spread that I had opened. Assuming that QQQ will fall below $301. This one is expiring on Tuesday of next week for the CPI report that's coming out. I'm actually pretty concerned about the CPI report for the month of January because we saw oil prices ticking up. And some other interesting notes was we saw home prices ticking up, which gets excluded out of the CPI, but it is an important measure. And we also saw car prices moving up. So if we head on over to Twitter, I think it's the car dealership guy. He was saying that he was seeing inflation in used car prices for the month of January, but the report doesn't come out until next Tuesday, so there's no confirmation of this. But basically, he said, I can't stress this enough. The pace at which used car prices are rising at dealer auctions is absolutely baffling. As of this morning, auction prices are much higher than they were in January. So we're seeing a rise in inflation for used car prices again, which means that there is just so much demand still within our economy because interest rates ended up coming down, from 7% mortgage rates to 6% mortgage rates, and then people bought up homes based on that small drop in interest rates. And the same thing happened in the car market too. Like interest rates came down probably a good 0.5% to 1%, and people had that much more money to buy a vehicle. So that's what's known as aggregate demand. Whenever interest rates drop and prices drop, people will, flood the market and buy up that. You also saw this with Tesla. Tesla ended up dropping their prices for the Model Y from $65,000 to $53,000, and basically immediately they saw a rush of demand coming in the door to buy their vehicles. So they saw, like a 20% cut in the vehicle prices, and there's been substantially more demand for them, and now they're starting to raise the prices of Model Ys again to tamper the demand. So they went from $53,000 to now $55,000, which shows that the demand for Teslas and these high-end vehicles and vehicles overall is still very, very high. What is my go-to strategy for options trading? Spread options. Most of my trades will be spread options. If we head on over to my spreadsheet, the handy-dandy spreadsheet, I track all of my trades here, and it also differentiates the strategies that I use. So we look at my strategy stats. I have made a total of 79 trades so far since the beginning of this year. 38 of these have been debit spreads. 28 have been credit spreads. So that's a cumulative 28 plus 38, 66 out of 79. 80% of my trades have been spread options. And then, I'll throw in a long put or long call every now and again. Sometimes an iron condor, which is also sort of a credit spread in a way. Then iron butterfly, also spread type. But most of my trades are going to be spreads. I believe spread options are the most capital efficient, especially right now when you want to be saving cash as much as possible with the Fed raising their interest rates. I would say cash is king right now, even with inflation being at 5%. Stocks have a long way to drop. Again, something that I posted on Twitter was that we're only down 12% from the all-time highs, or 13% from the all-time highs. After raising interest rates by 4.5% within the last year, we're in the midst of stagflation, where we're seeing the economy slowing down in terms of the growth rate, it was like 7% growth in 2021 versus now we're only seeing, between 0 and 3% growth depending on the quarter. So we're seeing a slowdown in growth. We're seeing prices continuing to tick up with inflation, and we have a recession probably coming in the next 6 to 18 months based on my best estimate. Now, obviously, I'm not a clock for whenever the recession is going to hit, but my basis for that timeline is the lagging effect of the Fed raising interest rates. The lag effect is usually about a year because people aren't going to refinance right away. So by October, we're really going to see the effects of the Fed raising interest rates from, I think it was 0% to around 3% in October of last year. And now, we're at, 4.5% or so. So we're really going to start feeling the effects within the next 6 to 18 months. And that's why I think we're going to have a recession within that time frame. But somehow, SPY is only down by 13% from the all-time highs. So I think that is concerning, to say the least. All right, let's continue watching the SPY. Great, quick question. How do you make money on a strangle if the profits are canceled out by the losses of either the calls or the puts? You can close one side versus the other if you're worried about one side getting, hit for, with a strangle, I'm assuming you're talking about a short strangle. Let's see. No. I'm assuming you're talking about a long strangle, actually. So if the losses are canceled out by the other side of the trade, then there's not really much you can do to manage it unless you decide to buy another one of the option that's gaining value, but then you're going to pay that much more in order to open that option. Not really sure how you would try to make back that money. You could also sell an option to make it a spread option on the other side, but then the value of that option that you're selling really isn't going to be worth much. So it's kind of hard to manage that. I feel like if you take a loss on a strangle, then you should just cut it. I've never been like a huge fan of rolling options personally. I made videos on rolling options, and for some people it can be useful, but for me, like, I'm just looking for new trade ideas each day, right? I don't want to just recycle the same trade over and over and over again. I'd rather come up with a new opportunity and try to make money off of it. Rise in IV, would it be the rise in the IV? If there is a rise in the IV, both of the options would be gaining value, actually, to some degree, unless the delta ends up getting rid of that. Right, so the delta value is how much your option changes for every $1 change in the stock price, and then the IV is trades hand in hand with the Vega value. So if you see a rise in Vega, then your option is going to go up by the Vega value times the change in implied volatility. So if you see a decent climb in implied volatility, then that would outweigh the delta value from the change in the stock price. But if it doesn't, then you would probably just end up taking a loss on one side or the other. Yeah, sideways market will kill a strangle, absolutely. Especially with the double theta value that you're getting out of it. Started buying leaps for 2025. Seems to collect short premium on them. Yeah, I think that's a good idea too. That's what I've been doing with a couple names. Well, actually, just one name right now. I've been using it on gold. I think that gold is a decent investment heading into a recession, and given that we have, the global turmoil with Russia, China, I think that gold is a decent investment. The sleeps option that I bought is up by $30, and I'm waiting until the CPI report next Tuesday, and I'm probably going to sell a call option then, depending on where the dollar is trading to. Like if the dollar isn't trading very high, if the dollar isn't trading very low in relation to where it's been, then I wouldn't want to trade. I wouldn't want to short a call option on gold, right? Whenever the dollar falls, gold goes up, and the reverse, whenever the dollar goes up, gold goes down. So you want to try to sell call options for GLD whenever the dollar is down a significant bit. And right now, the dollar is down pretty heavily, but we're not seeing that much of a rise in gold. We did see some in the pre-market when it went all the way up to 156 almost. But looking at the dollar index, this one's making a little bit of a recovery, but it is up if you look at a longer time frame, right? It started at $100.82. Now it's at 102.80. So if we see like a pullback, say to 102 or so, then I would probably want to take a short call option against gold. All right. The McDonald's put credit spread is doing pretty well now. The SPY put credit spread is just breaking even at the moment. Just got to keep a close eye with that $413.13 support level that we ended up bouncing on. So if we look at the volume here, we saw an increase in volume, and now we're seeing waning volume possibly. Let's give it a couple more minutes and see if we can confirm that or not. If we see that spike in volume when we hit the price level and then a drop in volume after, we should see this end up holding and probably trading either between these two price levels at 413.13 and 413.95, or possibly above that 413.95 mark. But with the RSI at 40 at the moment, I would say that's pretty bearish. Do you think the U.S. will need to replenish its reserves? I think that they already started to replenish the reserves, or they are supposed to start replenishing the SPR. I thought they had announced some more buying of SPR, but maybe I missed the memo. SPR levels. It's kind of flattened out to where we stopped draining the reserves in December 30th. Well, we came close to stopping. We had 372 million in reserves, and now we have 371 versus before we were just draining it like no other. If we look at the chart here, draining the oil reserves from 582 to around 372, and then we've kind of slowed down ever since. But hopefully, yeah, we start buying back the reserves, because the lower our reserves, the more that prices are going to remain high, because prices are just based on supply and demand. And if we don't have that much supply, we're going to have to buy from other people. And you know how OPEC is. They've been strong-arming us for a good bit. But we flattened out the reserves as of January 6th. But they said that they would start buying for the reserves when oil went below 80. I'm surprised they haven't done that yet. gas prices have been going up decently in the last few weeks. It was down to around 350, 360 where I'm living, and now it's at like 370 to 380. So we saw a decent tick up in the price of gas too. I wonder if we can take a call credit spread too. I don't know. I'm kind of hesitant on the call credit spread. But looking at the technical analysis, I would say that it could be a decent idea. Maybe to assume that we'll stay below 415 is pretty close. But that was the high for when Powell spoke on Monday. So it might not be bad. Let's check how much that's paying. SPY. Alright, so if we assume that it'll be below $415, it's $1.50 away, so it's not much change. We're getting paid $26 in credit. That's a good credit for sure. But you are taking on that extra risk since it's so close to the strike price. The 416, 417 call credit spread, on the other hand, is paying 18 cents. So you're getting like 50% more for that $1 lower strike price. But I think I'd rather take on that 416. All right. And I'm just going to open the same amount as I had for the put credit spread, which was how many of these? 3 of these. 3. They're going for 19 cents now. Let me score that right quick. Oh, the bid just dropped on me. God dang it. 2 at 19. All right. Please place my order as fast as possible. Oh, please. There we go. All right. Just opened 3 of these, not 2, but that's okay. So just opened a call credit spread, assuming that we're going to be neutral today. New options alerts, premium. Just opened a new SPY call credit spread that expires today. So this is a day trade, 2/9 expiration. Got them at 19 each. All right, day trade. Sweet. And we're right at that 413.95 level. So if we stay below that and in this tight range of 413.13 and 413.95, then that is definitely a score. And now we get a cumulative 19 cents plus the 26 cents for a total credit of 45 on each trade for the 3 of them that we opened, $135, which means that we're reducing our risk to just 165. So it's always nice to reduce your risk, and I think going back up to that price level after what the Fed had to say yesterday, it's pretty unlikely, but we shall see. Looking at the RSI, I would be more tilted bearish today, potentially, but just keeping a close eye on that 413.13 price level that we bounced above. Volume is starting to drop after we tagged the price level. So let's see what volume does if we go back up to the 413.95. Make sure to log it so I don't forget later. SPY, put credit spread, bullish to neutral. Expiration date was today, day trade. Strike prices were 412. Whoops. 412, 411. 3 at 26 credit. And SPY, call credit spread, which is bearish to neutral, so that makes this a neutral trade overall. $2.9 expiration. Strike prices I chose were 416, 417. Wrong way around. And I opened 3 just like with the put credit spread for 19 cents a piece. All right. Let's see if there's any earnings plays that we can take on. Head on over to Twitter with eWhispers. I know PayPal is reporting earnings today. I already traded them and made a profit off of their earnings, so I'm not going to recycle that trade. My assumption was that it would be bearish because Wall Street was expecting their margins to improve, and I don't think that's going to be the case. But we shall see if that's the truth. Most anticipated earnings releases. This is the wrong calendar. Where is it? Where is their famous earnings calendar? There we go. All right, so we got PayPal, we got Lyft reporting earnings after hours today, after Uber reported earnings yesterday, so that one probably already made its move based on what Uber reported. I want to look at the difference between their cash flow statements, though, to see if Lyft is like the traditional growth company that's burning money like no other. Expedia, Aurora Cannabis. Yeah, I would take a trade for Lyft. So let's go to Lyft, Investor Relations. And I'll take you through a quick little free cash flow analysis. Financial reports, SEC filings. We want to look for a 10Q filing. That was last year. Last report was on November 8th. Get the PDF file. And we want to look at their cash flow statement. Yeah. Cannabis stocks in general have not had any popularity as of lately. Legislatures just continue to screw over the cannabis industry, so not seeing much of a rise out of it. Hopefully with I don't know how McCarthy feels about cannabis. I'd have to look up his stance there. He looks like he smoked a lot of weed back in his day, though. Anyway, looking at the free cash flow statement, or the cash flow statement, I should say. Operating activities, they lost $200 million in cash in the first 9 months of 2022. Yikes. Cash flow from financing activities cash flow from investing activities was $52 million that they added to their cash balance, and net cash used in financing activities was $67 million. So they're burning cash in financing activities and in the operating expense, or in the operating business. Oof. And they only have $312 million in cash left over after burning $200 million in cash in the last 9 months. So if they continue to burn at this rate, Lyft isn't going to be around for very long. So this is the perfect example of a company that is burning through cash like no other in order to grow their business. And that is not what you want to see whenever the Fed is tightening interest rates or jacking up interest rates and tightening the fiscal policy as much as they have. But I'm sure that Lyft is going up similar to what Uber did. Actually, not really much change, interesting enough. Would have been a better short to take on at the beginning of yesterday, but now it's back to where it was before and a little bit below. But let's do a price analysis here and then possibly make a trade for Lyft reporting earnings after hours today. I think that's very concerning that they're down to less than 9 months of cash left based on the recent burn rate. That is not a good place to be in right now. The low of this candle was 1575. Another gap in the chart. Let's see, right around here at 1460-ish, 1470 maybe. Low of this candle was 1466. All right. And above, we're looking at a resistance with this candle of significance right here. I'd say that's about the halfway point, 1925. It's not going to be perfect, but donated exact. What else we got? We got this candle. I guess this is a gap here too that we could use. The low for this candle was 1792. Now this, I think, is a decent short opportunity. Let's see. So we got 4 price levels, 2 above, 2 below. Now let's look at the hourly chart. All right, so this is a candle of significance right here, which we ended up bouncing on a couple times later on. Right, roughly 1665. Make it blue to differentiate the hourly chart. I mean, these are pretty close together to where we don't really need to drop too many price levels and overcrowd our screen. To the upside, looks like we could use the 5-minute chart even to get the open candle of yesterday after Uber reported their earnings. The open for this candle was $18.48. And this will be a red line because it's on the 5-minute chart. So that is your price levels. Now let's look at the volatility analysis. So it's expected to move $2.50 in either direction. $2.60 almost in either direction by Friday, tomorrow. And then by next week, it's expected to move $3.10 in either direction. So currently it's trading at basically 16.97. We'll call it 17 just for round number's sake. And then we have $3.10 in either direction. So it's expected to be between $14 and $20 by the end of next week. So what I'll do is I will go back to the daily chart. And I'll draw up this as a nice little rectangle. $14 and $20. It'll be extended out to next week. I wonder if there's a way that I could outline it. What I don't like about Thinkorswim is I like how this looks whenever you're hovering over it and it's outlined. That way it gives you a clear distinction of where the support and resistance levels are, but doesn't seem like they have that feature. Anyway, so this is the price analysis for Lyft. Again, they're burning money like no other. So I think this is going to be a negative report. They're not going to have much cash left if they keep spending the way that they are. And companies that don't have a lot of cash left are, on the verge of bankruptcy in a market or in an economy like we're going through right now. So I think personally that it's probably going to go below 1650. I would say it's a safe bet for next week. Lyft is a ticker, LYFT. And assuming that we go below 1650 by next week, we are paying 29 cents to make. The bid is 21, the ask is 29, so we might be able to get this at like 27 or 26. So that means we have about a 1-to-1 risk-reward ratio. That's actually not so bad. What else? I also want to consider the implied volatility percentile, another important study whenever you're trading earnings. And if we look at the daily chart over the last year, it's at 75 IVP. Usually I don't want to buy a call option or a put option if it's above like 60 or 70. That means that you're going to pay more for an option than you otherwise would if implied volatility was lower relative to where it's been. Like if I wanted to find a put option that had a 1650 break-even price, I would need to go as high as 1850 strike price, 2.4. Let's see. Actually, that one has a break-even of 1610, so that's not even worth it, and you're paying like 250 for that. And I don't like to spend a lot of money on earnings. Like most I'm willing to put up is like 300. But let's see. The bid ask on this is pretty wild. 19 and 35. I'm hoping that I can get them at like 20, between 28 and 30. I don't want to pay more than 30 for these. That's for sure. And I'm spending 200 to open 7 of them. Oh, I got filled right away. That's shocking. All right, so I got that Lyft put debit spread, assuming that it'll be below 1650 based on their cash flow statement. So that's a earnings analysis for you and how I do my earnings. New options alerts. Just opened a new Lyft put debit spread that expires next week, which is 217, I think. And I got them at 196 over 7, 28 cents each. And this is a swing trade for earnings. And the strike prices I chose, assuming below 1650. That's a really good trade in my opinion, but we'll see if I'm right or not. Earnings are binary, so they could beat on their earnings per share and the stock could go up, but my analysis is more so based on the cash flow statement. I think that having that little cash available right now is a very precarious spot to be in for any company. Lyft reporting earnings today after hours, and their cash flow statement shows they only have about 12 months cash left. All right. Looks like SPY is dipping below $413 right now. Up still 0.5%, but below that 413.13 mark. And if we're checking out the studies, RSI MACD, we're seeing a drop in volume right now, so that probably means that we're going to stay below it. So for me, means that I'm going to close out of my put credit spread that I had opened. Cut my losses there. Hopefully they're not too substantial. 0.33. I opened 3 of these. All right. Actually, let's see if volume is waning. All right, we're 1 minute into this candle, actually, so we might be seeing more volume and a rebound to that 413 mark. Good morning, Julio. Welcome. We can even go to the 1 day, 1 minute chart to be a little bit more granular here. Make it more immediate. All right, yeah, we're seeing an increase in volume after crossing that, so probably going to head back to it. What's the news this morning? We had the unemployment report come out higher than expected at 193,000 versus last month was like 180. Jesus Christ, that is a sell-off. That is wild. All right, well, looks like the market makers want to test me on this. All right, we're at that 412.10 level now, so that's basically where I'm going to start taking my max loss. So I want to get out of this pretty quickly. I just don't want to get out at such a high price. I opened 3 of these, and I'm going to try to get out at 38 would be nice, but not sure if we'll get out of it there. Definitely saw an uptick in volume at 413.13 though. So maybe we can wait a little bit, let the markets cool off a bit. Yeah, I think I'd be willing to get out at 38, take my loss there. Don't want to risk. Since we're below 50 RSI, I'd say that the risk is definitely to the downside today. All right, there we go. So took like a $30 loss on it, but better than taking a much larger loss. Closing options alert. Premium. Just cut losses on the SPY 412, 411 put credit spread that expires today, 2.9 at 0.38 each. SPY below 413.13 mark, and RSI under 50. Might start selling off. Let's see if there's any fundamental changes as to why that might happen. So the 10-year treasury rate is starting to climb. It's starting to regain some of what it lost overnight. That could be the reason to it. You have the dollar index also making its way back up a tad, but still, relatively low compared to where it was yesterday. I mean, they're down 0.5% and 1.1% for the 10-year treasury rate. So it's kind of shady to see this market sell off, but I'd rather not take my chances and take a big L. That's what I've been trying to focus on, is taking smaller L's than I was previously. My losses would be huge, but let me log this in the trade log. It was for the put credit spread and strike prices. We got that, and I ended up closing at a 38. Oh, whoops, that is not the right value. There we go. $36 loss. Sweet. So this month, so far, starting the month, 64% win rate. Average win has been almost $80. Average loss is about 60. So you can find the expectancy and how much money you're expected to make each trade by multiplying the win rate that you have, 65%, by my average $79 win. Subtract that with the loss rate, which would be 1 minus the win rate, 0.35%, or sorry, 35% multiplied by my average loss, which has been $61. So my average expectancy, how much I'm expected to make each trade, currently is $30 to start the month. So in order to make $100 a day right now, I'd need to make about 3 trades a day. Call credit spread is doing well. The put debit spread for the Qs is starting to go back to break even, which is good. The McDonald's trade is back to break even, which isn't good. But that is our hedge against the Q trade. And then our gold ended up pulling back with the dollar rising. So, pretty flat day for me. But this call credit spread ought to make us a good, decent profit. They're still trading at 9 cents a piece, assuming that we won't go to 416. I'd say there's a decent chance that we're not going to head back to those price levels. Let's see. 416 is way up here, which is like 4 price levels away. There's no news coming out today. And these are still trading for 10 cents each, which I feel like is a decent credit out of it. We can wait a little bit if we do end up coming back up a tad. Maybe if we come back up to like 412.75 or 413, I'd be willing to open another one, collect a little bit more credit. We already got $60. Try to open, let's say, 4 more, and that'll get us up to our $100 that I want to make today. We will be risking more money, $90 times 4, $360 extra risk that we're taking on top of the 80 multiplied by 3. We'd be taking on 600 in risk. That's a little dodgy. I don't like to risk that much. But I do have decent confidence in this. Maybe we can just open a couple instead of all 4 of them. We can make a little bit of a compromise, I guess. All right. So I'll open 2 at 10. And we're in. All right. Options, alerts, premium. Just open 2 more SPY, 416, 417 call credit spreads that expire today, 2.9 at 0.10 each. So now I got an average credit down to 15 cents, so that did end up lowering my average credit, but I have 5 of them, which means that I can make around $75 for this trade if all goes well. Now holding 5 at 0.15 credit each. I'll update this on my spreadsheet. 0.15, 5 of them. And then we still got that Lyft trade open too. I wonder how that's doing now that the market's pulled back a decent bit. Actually down by 7. Probably didn't get the best price for it is what happened. But yeah. How much to teach one-on-one? I charge $150 a session. It's a 1-hour session. What I'll do is I'll review your trades before, see what strategies you're using, how you can improve, So let me find my Calendly link and I will send that right on over. Copy the link. One-on-one options coaching. All right, and I'll pin that so you can keep track just in case we get flooded. That drop was due to the natural gas. I'm surprised that natural gas reports are shaking the markets up as much as they have. We had a gas report the other day, too, that ended up shaking the markets in a really big way. I guess that kind of feeds into the inflation narrative. Let's see. Natural gas prices steady ahead of the EIA report. That was at 8:25 this morning. Where's the latest? Let's see if we can find it on investing.com. Yeah, that's fine. I've taught anybody from brand new traders to, experienced traders that have hundreds of thousands and have been trading for years. Doesn't really make a difference. U.S. stocks are rising after a strong report. Crude oil heads lower. Crude oil is basically flat. But yeah, it saw a decent drop at around 9:20 in the morning, and then it's recovering some of that. If you're looking at just crude, I'm not sure. Can we search for natural gas? Would that be NG? Yeah, natural gas futures, huge volume uptick. And this is where we can find the report, I guess. EIA underground natural gas storage weekly recap. I have no clue how to read this, even if I tried. Monthly inflation expected to accelerate. That's to be expected. So CPI is probably going to come in pretty hot on Tuesday. That seems to be the consensus. I wonder if the economic calendar is showing that. Where am I from? I'm from Pittsburgh, Pennsylvania. Well, that's where I'm living. I used to live in Texas, which is a lot better, but stuck here for the next few years. My wife is getting a degree that takes 8 years, MD, PhD. So she's the brains and I'm the moneymaker. Well, she's going to be the moneymaker someday, but let's see. So next week is when the CPI report comes out. 8:30 in the morning on Tuesday. Philly, really? That's nice. Never been to Philly. It's huge, though. Compared to Pittsburgh, it's probably like 5 times the size of us. And Pittsburgh really hasn't been gaining any population recently either. Like since the boom of the steel industry, Pittsburgh, it's just been flat in terms of the growth rate, the population growth rate. And I see why. Like the roads here, garbage. The people that are managing the city, garbage. Like I despise it here, but it is what it is. I'm still here for another 5 years, so I have to deal with it. Is my Google call still open? I don't think so. I don't have Google Trade anymore. I think I ended up taking a loss on that one if I did Google. Where is that? Was that in the January calendar? Let me search. There it is. I had a Google put debit spread actually, so not a call, but a put expiring 2/3, so that is about a week old at this point. And for that trade, I guess didn't log the end of it. What was the ticker? Goog. 98, 99 strike prices is the ones that I chose. I think it just expired worthless. Yeah. So 2/3, This should say expired, and then I just took the max loss for it. So 270 loss for that trade. Let's tag these very quickly, and then make sure we log the Uber put debit spread bearish strategy. Expiration is next week. Bearish strategy, not bearish neutral. I opened the 17 strike price, 16.50, 7 of these at 29 cents each, if I remember right, or 28. Lyft. Oh, sorry, this is Lyft, not Uber. I already made my Uber trade that I made money on. Lyft. 7 of these that I got at 28 each. Would I consider re-entering Google? No, because I'm more of an event-based trader. I like to trade on earnings. I don't like to trade elsewhere. If I'm going to make a trade that's not an earnings report, it's usually just going to be SPY or QQQ. That's just my style of trading. It's trading based on events, economic events, like the economic calendar that I'm always showing, or if it's in earnings. Those are usually the only trades that I'll make. Let's see, Lyft, this one is an earnings play, so it gets labeled as orange. This one was a call credit spread. This one I opened, let's see. I know this one I opened based on the fundamentals. So this will get labeled as green. This one I opened more so based on what the Fed had to say. So this one I would label probably as econ data or econ news. I'll just label this as macro instead. I feel like that's more suitable name than econ data. So macro, earnings, technical analysis, fundamentals, and news is what I trade based on. News is the least frequent. The most frequent is macro trades, and then sprinkle in some earnings, usually about 2 or 3 times a week. Do you have a certain amount of trade in your account to day trade? Not for day trading specifically, but for my options account, yes. So my total account for Robinhood is 30,000, but I limit myself to only using around 5,000 in total. But that being said, I'm never risking more than 5% per trade. So 6,000 multiplied by 5%. I'm never risking usually more than $300 a trade. And then I usually never have more than about 5 trades open at a time. So at any given time, I'm only risking roughly $1,500. My only exception right now would be the gold leaps that I have open, which ended up costing me $3,100. And this I see more as a long-term investment because it is a leaps option. So I make an exception for that. It has a lot more time to gain value based on my analysis. All right, the SPY call credit spread is down to 9 cents each. Got them at 15, so making 32. QQQ put debit spread currently down $7, almost break even. Let's see what's dragging the account today. Today's return up 32, down 56 for the put debit spread. So that might be what's really dragging us. I guess we're only down $81, so not really moving much. Yesterday I was up like a good $400 or something crazy like that. And that was thanks to gold. That was thanks to the VIX going up, whereas the VIX is pulled back down 3.5% today. Yesterday it was up by like 5% at 523. So I could have probably sold some covered calls and made some profits on that, but I did not pull the trigger for it. which options would I recommend for people starting with 10,000? I think that starting with spread options would probably be your best bet. And then once you work your way up to, trading with tens of thousands of dollars, so if you're working with like 30, 50, $100,000, then I would start just buying regular calls and regular puts, but it really depends on implied volatility too. Or what you can do is you can widen your strike prices, so you're using more collateral per spread, which also helps you with the break-even price. You are going to get less credit per spread versus a narrower spread width. Like if you have a $1 spread width and a $5 spread width, you're going to get less credit per collateral with the $5 spread width than the one that has a $1 spread width, if that makes sense. So I would say that under 10,000, I would use mostly spread options. Over 10,000, you could start to incorporate some leaps options, and buying shares of companies would help too. What is today? Today is Thursday, so today could be dollar cost average day. Tesla, I heard, was going up today. I haven't checked in on it, but it is currently trading at $211.52. What a ridiculous stock. 8th day in a row that it's up, $212. I'm more happy to sell Tesla at $211 than to buy it, but man, momentum is just carrying the hell out of this stock. All right, if it's up 8 days in a row, I feel like it's going to be down tomorrow, but who knows with Tesla? It's something new every day with Elon Musk and this company. But yeah, I'm going to buy my little $100 of Tesla, I guess. I'm only getting half a share. I bought these at how much a piece? An average of $144 each, and they're already up by 50%, which is ridiculous. It makes me so hesitant to buy more, but you know what? I'm just going to hold off on dollar cost averaging. I feel like it's just out of reach. Instead, you know what I'll do? I'll put $200 into Fulgent. It's been a few weeks since I put any money into this stock anyway, so I'll buy 200 worth instead of buying $100 of Tesla. We'll make it a little bit more flexible, I guess. So I got 6 shares of Fulgent, Genetics. Oh, my MacBook's about to die, so I'm going to have to log off after I post this. But 6 shares of Fulgent for $200. Buy alert. Premium. Just bought 200 worth of Fulgent. So now I have a total of how many shares? Actually, you know what? We're going to take a screenshot of the whole portfolio. And then head on over to Fidelity as well. And I also want to buy $100 or $200 worth of, what was it? QQQX. You are now logged out. So log me back in, please. I hope it doesn't two-factor authentication me. God dang it, I don't have my phone with me. All right, so the plan is to buy $200 worth of QQX. So if you don't know what that is, it is a cover call ETF that sells cover calls on QQQ, and it pays roughly a 8% yield per year. So this is a nice little income stock that you can purchase. Currently trading at 23.5. So if you don't have hundreds of shares of QQQ if you can't afford that. This is a nice little alternative. But yeah, that's all the trades that I'll be making today, and I guess I will catch y'all tomorrow, Friday, at 9:30 in the morning. See you, everybody.